Andrew, Pranjal, thanks so much for joining me today. A little bit of discussion before we started of you're making the rounds on a paper that sort of like hit the interest of markets and insurers around how private credit is moving into the life industry and how it's changing in some ways, and what the regulatory view of it is. So I always like to start off a little bit about yourselves. Andrew, I'll start with you. Where are you from and what are you focused on right now?
Yeah, so I'm an assistant professor of law at UT Austin. I was actually born in Iowa City, major insurance area, and I grew up mostly in Columbus, Ohio, also another major insurance area. But my interest in all of this started when I worked as an associate economist at the Chicago Federal Reserve. I worked in their insurance initiative, and so that interest has continued on as I continued into grad school and now kind of start as a professor.
Pranjal, a little bit about yourself.
Okay. So I grew up in New Delhi, India, and I came to the US for undergrad and, went to Grinnell in Iowa, which is, only an hour away from where Andrew grew up or was born. And then I started the JD PhD at Yale 3 years ago. And most of my research is in finance and financial economics with a specific focus in financial regulation and bankruptcy. Most of my other work currently is in some aspect of private credit. And Andrew being an expert in insurance, started thinking about writing a project that sort of thinks about the two in conjunction with each other. And that's how we got started.
Yeah, that's great. And it's perfect timing in a lot of ways because, I've been following this issue for almost a year, talking to different people. I talk to rating agencies about it. I talk to investors about it, and everybody has like a different perspective on it. But it's like the paper that you put out is sort of unique because it's tying it to sort of the overseeing and the regulatory aspect of it. So, it seems like a completely different approach than the way other people are thinking about it. And the argument is, if I understand it correctly, is that insurance regulation itself has become part of, the private credit infrastructure. So for people who are sort of listening to this, and these are like investors and some people in the industry, what is the focus of, what's the takeaway from the paper? Is it about the private credit, or is it more about the insurance industry and how it's changed? And Andrew, I'll kick it off to you first.
Yeah, so a lot of the discussion around the kind of like, the conceptual and literal merger between private equity, private credit, and life insurance has been about the story of permanent capital. This idea that because life insurers have classically very long dated liabilities, limited options for policyholders to exit, this enables you to hold as a life insurer highly illiquid long-term assets on your balance sheet without being subject to the same kinds of risks or liquidity needs that you would have to, be upholding if you were doing this through a standard, perhaps 10-year private credit fund or even shorter terms than that. And the point of our article is to not necessarily like dispute that narrative, but to qualify it by also saying that the structure of life insurance's insolvency, tax, and financial regulation law really amplifies the incentives for private equity firms to pair insurers with opaque private credit and ratchet up the risk on life insurer balance sheets in a way that takes advantage of the fact that policyholders are not institutionally well equipped to monitor insurer behavior. So to be more specific, let's say I have a classic private credit fund. I have a general partner, that is managing that fund. I have limited partners, LPs, who are the investors. Those LPs are institutional investors, pension funds, large university endowments, high net worth individuals, et cetera. And they have strong incentive to monitor. They have strong incentive to, kind of be repeat players with the private equity firm or the private credit firm that is, that is managing these funds. And so it's important to like keep them happy. On the other hand, if you have a life insurer, most of the capital that is invested in a life insurer comes from the policyholders, who are technically creditors. They show up as liabilities on the life insurer balance sheet. But life insurance policyholders are highly dispersed. This is a retail base of policyholders. And importantly, under the standard insurance guarantee fund structure that virtually, every state in the United States uses, they are insured on their insurance, usually up to somewhere around the first $250 to $300 or $400,000 of value in their policies is covered by an indirect state backstop. So if policyholders who are like nominally the creditors of the firm are not monitoring the insurer, and also private credit itself is highly opaque and difficult to value, and therefore liable to be used as regulatory arbitrage when conducting NAIC risk-based capital requirements, you end up with a very strong set of incentives for these firms to massively ratchet up the risk on life insurer balance sheets in ways that are not being captured fully by the NAIC's RBC ratios, and that are not being appreciated fully by the people who are nominally the creditors of the life insurer.
Pranjal, do you see what are your thoughts?
Yeah, no, I think that's a great framing. I think big picture, I think our paper, it would be a mystery of the paper to suggest that private credit does not belong on the insurer balance sheet. I think the thrust of our paper is private credit is a big asset class. Insurers want access to lots of kinds of debt products, and private credit is one such product that offers a very specific return profile. And it's in a world where liquid, publicly traded debt is hard to come by. It's not hard to imagine that insurers want access to be able to invest in private credit. I think, as Andrew points out, given that backdrop, regulators need to be a little bit more alert to how to think about valuations and solvency regimes, and whether our portfolio is sufficiently de-risked in terms of like when there's a downturn and whatnot. So I think a lot of the messaging is towards regulators and improving the insolvency regime. And just to be clear, you might imagine that in the olden days, an insurer, to take a certain amount of risk, would own really safe public debt and then some risky equity. And in 2026, it actually might be optimal to hold something like a private credit loan, which combines features of those with like a slightly more risky product than like public traded debt, but maybe doesn't have the craziness of like holding an equity position in a CLO. So there's definitely good reasons to hold private credit, and we don't like fight against those reasons. And obviously there's like the classic sort of illiquidity premia type idea where like insurers can hold assets longer, private credit is generally longer term, doesn't get traded as much. So insurers are in a good position to capture that premium. I think given all of that backdrop and the benefits of private credit, as long as regulators are like more aware and more on the beat, and we can figure out a lot of the rating agency problems, then I think the cause for concern would be significantly lower.
Yeah, and I get that point. I mean, especially when I talk to credit rating agencies, like the bigger ones, they love the liability matching aspect of it. But I guess my next question comes to like a little bit of a chicken or egg question. Traditional life insurers, were constructed to absorb mortality and mortality risk, and today some of the largest life insurers are owned by asset managers, as Andrew mentioned, that view them as a source of permanent capital. Has the role of insurance fundamentally changed? Are insurers becoming less about underwriting insurance and more about like a financing vehicle? Has everybody become enamored with what Buffett described as the float?
Yeah, it's interesting. So something that's notable and something that we're actually going to explore in a follow-up paper is the degree to which that private equity affiliated insurers tend to move more prominently into annuities rather than life insurance per se, and specifically kind of variable forms of annuities. So these are products that kind of get increasingly close to mutual funds, although they include hedging provisions that distinguish them. But in a sense, it's sort of moving the entirety of the life insurance industry towards a asset manager model, but one that is not subject to the standard investment fund regulatory regime, but is subject to the life insurance regulatory regime, which functions very differently and I think offers a lot of opportunities for arbitrage.
Pranjal, yeah, what do you think about that? Because, I do see it a lot. I mean, even, I don't know if you've seen Bill Ackman, this is it could be in the life insurance space. Theoretically, he started it, and he was a big hedge fund manager, just bought an insurer with the thought of, and again, he's talking about permanent capital to build on that. What are your thoughts about that aspect?
I think the intuition is roughly right. I also just want to give the other side of that coin, which is that Allianz SE owns PIMCO and has a large insurance business starting in the 2000s. So the idea that an asset manager owning an insurance company is using the premiums to fund some privately beneficial investments is not new. I think fundamentally, though, it would be there's a lot of economies of scale where an insurance company needs someone to invest their money. Usually an insurance company is not the sexiest place to work if you're trying to hire high quality asset managers. So the idea that we can outsource the asset manager function to like a PIMCO or a Blackstone or Apollo to attract better talent and to make better investments is not a crazy idea. So I think in of itself, you can still have the mortality pooling risk function and have this like permanent capital story go hand in hand, because there's good reasons for an insurance company to outsource, asset management to a firm that specializes in asset management and has a lot of the technology built in from having really good monitors and LPs. By serving Yale and by serving the Saudi investment fund, a lot of these companies have built out really good asset management businesses. So insurance companies tapping into that can also benefit policyholders by giving them better rates. So I think at least conceptually, it's hard to go either way too strong because there's good reasons to be having professional asset managers manage capital on your behalf.
Yeah, that's a great point. The other aspect of the article and the research was about, one of the arguments is around state guarantee funds and, premium tax credits and, whether or not they create a implicit subsidy around these structures. Has anyone, actually tried to quantify that as a liability or contingent liability? And how does that work into sort of the municipal bond side? Should they be paying attention to this exposure? I don't know if either of you can talk to that.
So the quantification of this risk is extremely complex. Just to kind of lay out the structure of an insurance guarantee fund, what happens is that if a life insurer goes insolvent, then the state insurance regulator, takes over the company and then, has to see if there's enough money in the company to be able to make payouts to policyholders. And the statutory scheme says, depending on the state, that every policyholder is guaranteed the first, let's say, roughly $250,000 to $300,000 of their life insurance policy. Depends on the state, depends on the product line, but let's just call it $300K. If in the event that there's not enough money left in the insurer to fund these payouts, the receiver has to levy an assessment against every other life insurer in that state. So if I am in Ohio, my insurer goes down, every other insurer in Ohio is going to get a bill that is calculated using the percentage of premium volume that that insurer has sold in Ohio in recent years. So if some other insurer in Ohio sold, 0.5% of the premiums that year, they're going to be responsible for like 0.5 of the percent of the assessment. There are some like technicalities to that that I'm not getting into, but like for simplification, let's just say that. Then what happens is that depending on the state, but in most states, you get a tax credit that you can then reimburse over the course of 5 years at 20% per year. So if my insurer gets billed $1,000 in the assessment, then I get a $1,000 tax credit. And that tax credit I can take for $200 a year over 5 years in most states. And then there's some states where the timeline is a bit longer, say 10 years. And then there are only 6 states where there actually is no tax credit at all. So in 44 states, we argue that this regime is functionally equivalent to a public backstop. Because even though the insurer is getting the initial bill for the assessment, they then transfer that bill over to taxpayers through the form of this tax credit that occurs by operation of law. So in 2008, you had all of these bailouts that were extremely dramatic legislatively. Like, the vote on TARP was this like seminal moment in like American political and financial history. And if major insurers go down, there won't be such a vote. It will just happen automatically, unless the situation becomes so dire that the guarantee fund system is just totally overwhelmed. And so that structure we argue is suboptimal in a lot of different ways. It doesn't take into account risk of insurers at all. It means that the insurer that actually goes down has never paid a single dollar into the fund that ultimately is going to guarantee their policyholders. It therefore indirectly cross-subsidizes risk from relatively conservative insurers who are going to have to be paying out these assessments towards these riskier insurers who are going into insolvency and whose policyholders need to be bailed out. And it creates this public backstop that occurs through this highly indirect, low salience mechanism that is just very poorly understood.
And Pranjal, I guess on that point, I mean, the guarantee system exists and it's been around for a while, and other people have done research on it where they talk about it in terms of the homeowners market and what if there's a large loss, and then so what are your thoughts on the guarantee system? And is there like a moral hazard issue, or is this being too alarmist? Would it have to be a significant issue for it to be pushed down to, let's say, municipal bondholders?
Yeah, I think that's a good question. I think Andrew and I were talking about this earlier. I think some states have up to 3% of their tax revenues come from insurance premiums.
Mm-hmm.
So that's like a big number.
Yeah.
So if you're buying state munis, you might, that's a big exposure. Obviously, 3% is the total premiums collected on all insurance. So by the time you think about the tax offset of the insurance guarantee fund assessments, it's unclear if that reaches 3% in a year ever.
Mm-hmm.
But just to, set expectations, that's like kind of some fraction of the 3% is what we're talking about. So that's obviously a big exposure from a muni bond point of view. I think big picture, there's definitely moral hazard. I think the guarantee fund system in of itself, if we think about the FDIC as sort of the gold standard, is, as Andrew pointed out, weaker in a bunch of different ways. So, and we like to talk a lot about in the paper, like how we can make it better. But I think at bottom, to get back to the muni point, I think I'm like a somewhat tepid believer in efficient markets. So I'm assuming there's some like muni bond trader who's already done the math,
Right.
and they're shorting the states. But at the same time, it's like there's 44 states that get that do this tax credit. Certain states are more reliant on insurance tax premiums than others. So like states that try to attract insurance companies are like more likely to are probably a higher share of their income comes from these. So I'm sure there's variation that way too. But again, I think if Andrew and I's paper is what's informing uni bond traders, I think they're probably behind the eight ball.
Yeah, and I think just the concept of like having this sort of macro risk in a state-based regulatory regime makes the opacity in the decision making that much more difficult.
Something that I think is very concerning to us also is the sheer lack of precedent for managing a large scale insurer insolvency through the guarantee fund mechanism. Like the insurer insolvencies that have actually gone through the guarantee funds kind of tap out at roughly like executive life type levels of a few $1 billion. Certainly it's never been the case that a company like, MetLife or Pru or now Athene has gone through the guarantee fund system in a way that would implicate a 50-state simultaneous insolvency and, hundreds of billions of dollars of assets. AIG would have been the first time that happened, but TARP, forestalled that from having to occur. And so I think the sheer logistical challenge is itself, I think, a major kind of lurking risk that we really won't know how that works until something actually, goes down on that scale.
Yeah, and by then it may be too late. One question I have is, and I guess this is a big question, is, do you think regulators have been looking at or asking the wrong questions or looking in the wrong places? Because there's a lot of debate around, the use of private credit, certainly being among investors, and some regulators have focused on it, but certainly not at the state level. And the state level seems to be like enamored with the concept of, data centers, which rolls up into often to the private credit question. So should they spend, should state regulators spend less time thinking about private credit funds themselves and more time on the insurance system?
Totally. I think it's a very good question, very perceptive. I think, so there's the insurance regime point, which I'll make in a second. One more reason to be skeptical of thinking a lot about fund investment and and worries from a regulatory point of view is that it's really hard to discipline. So number one, the traditional LP in a private credit fund is very sophisticated. So presumably those people are doing a lot of work to make sure their money is invested properly. Then there's retail exposure to private credit assets. And then, the classic sort of line is that more disclosure will help. But I think that sort of misses the point in that most of the private credit funds that like a high net worth individual is being put into through like a wealth advisor, there's limited exit. So the idea that disclosure will fix problems doesn't really work in a setting in like a fund context where, unlike an open-ended mutual fund, you cannot just leave.
Right.
Once you're bought in, even if there's some adverse disclosure, you can only join the queue to sort of leave when the fund provides liquidity quarterly. And even then, you're going to get a pro rata share of the exit. So I think that kind of like regulatory action it's unclear how effective that is. And the second question is it actually necessary? Where it's like, if a bunch of sophisticated wealth advisors and LPs made bad decisions, the idea that the SEC should spend a lot of energy on that, it's unclear to me if that's like a good use of regulatory resources. I think the insurance, the piece we're discussing here, which has broader implications, is a ratings agency reform. So a core problem in this setting is that smaller rating agencies, Egan-Jones namely, is one example where they have an incentive to sort of give generous ratings to get repeat business. And that is a core agency problem beyond sort of the difficulty of just valuing private credit assets or like private assets in general. So like there's like a baseline difficulty that's hard to value illiquid things. And then it's compounded by these concerns that Egan-Jones or other smaller rating agencies have an incentive to give favorable ratings to get business again and again. So I think focusing on that, I think, is a better way to spend resources, both at the federal and the state level, as opposed to thinking a lot about investor protection, if that makes sense.
It does.
Yeah,
I'm sorry, go ahead, Banner.
Yeah, so something that we think about in the paper is that the state insurance regulatory agencies face a lot of constraints. They generally their funding is simply not like nearly enough to the task of properly supervising the entire insurance industry. And so a lot of what happens, unfortunately, is that they have to spend their limited time, fighting things out on an individual asset by asset or transaction by transaction level, which is very resource intensive to do, especially when the asset is highly opaque. So like, let's take the example of, let's say there's some sort of highly liquid specialty structured loan. A ratings agency gives it a rating. That rating, it seems maybe a bit optimistic. The insurer puts it on their balance sheet. Now what's the NAIC or a state regulator supposed to do about that? If they want to dispute the rating, they have to conduct this entire investigation into, well, what's the correct rating for this? That's very hard to say. And when you have an entire industry that is systematically moving in the direction of more private credit, more liquid assets, more opaque assets, it's I think unfeasible for anybody, even if they were clairvoyant about valuation to be able to do this. And so we provide some recommendations to do sort of like kind of system-wide penalties that can happen for opacity that can happen automatically, rather than having, transaction by transaction or asset by asset fights. Those will inevitably still have to happen, but you could imagine, for example, a capital surcharge that kicks in if a certain percentage of an insurer's assets fall under a broad heading of, let's say, maybe a certain percentage of assets use private letter ratings, or that, meet some sort of regulatory definition of complexity. And layering that on top of the existing regulatory regime would have very minimal enforcement costs. But it would also, I think, help ameliorate a lot of these agency problems.
So as an argument, if you fix the opacity at the fund level, the rating agency issue will follow. I mean, will work itself out. Am I phrasing it the right way? I'm trying to conceptualize.
Yeah, so it would definitely help. Mm-hmm. So there's conceptually, there's multiple problems here. So one problem is the problem of like, are we getting the valuation right? And that's very hard to solve. Like, are we getting the right letter rating? Right. It's very difficult to say what the correct letter rating is, for anything. And especially, as you move out of publicly traded assets, you move into like, bespoke individualized loans. This gets very difficult very quickly. A separate conceptual problem, although one that's linked, is the moral hazard that the public backstop creates, and the like incentives that go along with that. So you can imagine, let's imagine a hypothetical, evil insurer that, what that insurer, a hypothetical evil insurer. And let's say it's managed by, some sort of firm that also extends credit out to affiliated companies. And those companies want, below market loans. And you can get those by having the insurer issue favorable terms to, an affiliated asset. So, that borrower, which is also part of the broader insurance group, is happy. But the insurer loses out. But if it's very difficult to say if the insurer is actually losing out because of a valuation problem, of a systemic lack of monitoring by creditors. You could potentially just kind of keep doing this. And even though you're pushing the insurer closer and closer to insolvency, you're making up for it by getting all these favorable terms for the portfolio companies. And if ultimately your insurer, let's say you maybe, fly a little too close to the sun and your insurer actually goes insolvent, well, that is unfortunate. But the downside is not borne by you beyond that. It's borne by this like constellation of policyholders and other insurers and taxpayers. And so you have incentive to do all of this under the existing regime. And that's not to say that any particular firm is doing this. Like as we've talked about, there are theoretical synergies to putting all of these types of businesses under the same roof, but there are also very real risks to doing so. And if the regulatory regime is not up to the task of monitoring these insurers, I think we should expect to see very aggressive maneuvers like that hypothetical one.
And well, Pranjal, let me ask you this. One thing I keep coming back to, and I talk to people in the industry about, what trends are going on. And it gets to what everyone is, you're both discussing, the opacity and the difficulty of following how quickly things move. Is one thing I followed is the development of funding agreement backed notes. It sort of like floored me about how quickly that market developed, how quickly it's being implemented. So I guess my question is there a mechanism to keep up with that sort of like, as the market just adapts and goes in different directions and comes up with these structures for the regulators to keep up with it and follow it and react? Does that question make sense to you?
Yeah, I think so. I think that's totally right. So see, a lot turns on how on the ball regulators are. I think the NAIC, to its credit, realizes the underlying problem, which is fundamentally private assets are hard to value. You outsource them to a rating agency. The rating agency has strange incentives. And the regulator is stuck in this weird place where they have to trust all the NSSRO rating agencies that are like defined at the federal level. So once you give them a good rating for a loan, they have to accept it. So the regulator is stuck in this weird spot where they can't really do meaningful ratings reform, or at least are constrained beyond it being a difficult problem. So in that spot, what do you do as a regulator? It's a hard question. So I think that's where like a lot of our solutions are, at least in the interim, focused on the sort of broad-based penalties, if you want to think about it like that, which is this thing is hard to value and opaque, even if it is actually like basically AT&T, private credit, and very good investment grade. We should just, in expectation, penalize it to deter sort of opportunistic behavior at the margin, where we know that this is a hard to do, complicated thing. Regulator doesn't have the resources. So instead of like doing nothing for 3 years, we will, in the interim, penalize all assets of this sort for the purposes of the solvency regime. And the idea is like, by the time we figure this out, we have this thing in place to make sure that we deter some of the behavior. I think that's like a short-term way to think about it. I think more conceptually, I think we should trust regulators, or like I'm like fundamentally an optimistic person. And as private credit has become more and more important to the financial system, I think figuring out a way where we can value illiquid assets better would be beneficial to not just the insurance regulatory regime, but also sort of other systematic concerns, like the Jamie Dimon cockroaches comment, stuff like that, where everyone was worried about, oh my God, private credit is going to go to zero in like 6 months. Stuff like that is fundamentally driven by a distrust in the valuations reported by the investment funds, which are fundamentally driven by valuations reported by the rating agencies. So all of that has implications beyond just like insurance solvency and just like basic financial stability concerns. So I think everyone is well incentivized to sort of figure that out. One more pitch I'll give you for even beyond just like the policyholder and the taxpayer. Say there's a good insurer or a good investment manager and a bad investment manager, and they both have access to different kinds of private credit. The good investment manager has access to investment grade, basically like the safest AAA stuff, but it's private. And then there's like a bad investment manager who doesn't have access to that, but they're able to show the world or like get a good rating that this is actually AA.
Mm-hmm.
At the margin, you're disincentivizing the good manager from investing in the AAA stuff.
Right.
Because the idea is I can invest in the crappy stuff,
right.
still get a good rating, and I'm happy with that. And so just by mimicking the sort of good investor, the bad investor is able to like create all these externalities. So if you're like a sort of a good insurer, you're also incentivized to sort of improve the regime.
So you brought it up, and I have to go. That's my next question. The cockroach go to zero question. So in your mind, if a PE-owned life insurer ran into trouble, like a solvency issue, where would the stress you think appear first? In banks and credit markets? Would it be in pension funds holding it? State guarantee funds? I assume that would be down the line, but do we really? What's the visibility into from beginning of the stress until it's actually showing up?
Great. So I think one way to think about private credit is that the underlying asset is the same, but it's packaged and sold to different investors in different ways.
Right.
So even before you get to the insurance point, there's business development corporations, BDCs, that typically are like a big vehicle that a lot of investors access private credit through. Some of those happen to be publicly traded. Some of those are private and non-traded. And the same underlying loans are packaged in different BDCs. So the first thing that usually goes down when there's stress or when JV Diamond made those comments and those like First Brands bankruptcies happened, and there was like concern about AI and middle market software companies, the first thing that went down was publicly traded BDCs. And then you slowly saw concerns go to the private non-traded stuff. Because the idea is that publicly traded BDCs, even if the asset manager is saying the loan is worth 94 cents on the dollar, the fund can trade at a discount. So typically you see the stress there very quickly. And part of that's like the investors are sort of really worried. So they're, because they don't have a lot of visibility. So they're maybe overreacting, some might say. But the privately traded valuations, when the publicly traded BDCs go down, typically don't go down that much.
Right.
And even if the underlying loans are the same. So I think insurance companies are sort of way on the illiquidity spectrum, super, super hard to late reactors. Partly because insurance companies are sort of supposed to be buying distressed assets in bad times. Like that's like the appeal of insurance from a financial stability point of view. So I think insurance would be sort of one of the last places you'd look as like a investor, because the idea would be, well, there's stress, a lot of publicly traded loans that are like maybe worth a lot of money in the future are trading at a discount, an insurance company snaps it up, and that might be entirely legitimate. But in the case of private credit, for example, recently when Blue Owl's affiliated insurer, Quave, or I forget the name, but they bought
Kuvare. I'm not actually sure how it's pronounced.
I can't keep up with the names.
Yeah, but the Blue Owl had two funds: the publicly traded BDC, a private BDC. The publicly traded BDC was trading at a big discount, like I think close to 20% discount to net asset value, and the private non-traded fund had a lot of redemptions. And one way the privately traded, the private non-traded BDC got exit was they sold assets to the insurer at 99 cents on the dollar. And I'm not going to say the valuation was wrong or it was an illegitimate transaction, but the point is that the insurer was a buyer in times of distress.
Right.
So if there's distress, it's hard to imagine that the insurance balance sheet is going to reflect that first. There might be stress in the broader credit ecosystem, and then it'll go to, so the insurer and the guarantee funds sort of come in almost by design, like way after insolvency.
So, Andrew, given all that, like, how does that, are there enough signals before it rolls up into a state guarantee fund issue, for actors to step in and, or is that not what you're thinking about? You're thinking about something where there's such a cataclysmic loss that there's no way of stopping it.
Well, so unfortunately, the classic way that the regulators would get signal that there is a problem that needs to be addressed is that, risk-based capital ratios would decline. But if that system is fundamentally breaking under the strain of the agency problems inherent with dealing with, these private letter ratings and difficult to value assets, then the quality of that signal deteriorates significantly. There's various empirical studies in economics showing that when private equity firms acquire life insurers, they immediately make substantial changes to the balance sheets of those insurers. They move out of publicly traded bonds. They move into ABS. They move into, private credit. They move into classically considered higher risk, higher yield categories. They often massively increase the percentage of the insurer's assets that are affiliated. So they're loans that are being made to other portfolio companies of the private equity firm. And yet the risk-based capital ratios of these insurers don't decline. And I think, again, valuation, very hard, et cetera. But I at the end of the day, I think it would be naive to think that after all of that, it just like happens to be the case that it just cleanly nets out in RBC terms. And so, in lieu of relying on the RBC ratios, we have to kind of start thinking about more systemic first principles. Like potentially thinking about, just like the percentage of the insurer's assets that are on, say, like Schedule D versus Schedule BA or something like that. But it's a very difficult problem.
And you've been really gracious, both of you, with the time. This is my last question. And it's sort of like, hopefully it doesn't veer off too much, but I think it is relevant to the discussion. There's a lot of offshore financial centers, Bermuda in particular, has spent a lot of time, building up their credibility as a global center for insurance, reinsurance. So, and they have a role. I mean, there's a role in this for those offshore centers. There's a lot of funds flowing through them in terms of private credit and annuities and life insurance. How should investors distinguish, between legitimate risk transfer and what they describe as shadow reinsurance, especially among an offshore center? Are those two becoming conflated, and is that because it's becoming so assets are driving it so quickly? I don't know who would want to take that one.
So,
Andrew, you got it.
So I think 2 points on this. So if I am an insurer and I want to conduct a reinsurance transaction, first of all, reinsurance is a totally legitimate thing to do, in general. But if I conduct a reinsurance transaction versus a independent reinsurer that has incentives, to advocate for itself, and kind of make sure that it's getting high quality assets along with those ceded liabilities, that's very different from a captive reinsurer where you have control over that reinsurer's actions and can force it to accept reinsurance deals that an independent reinsurer, might think were terrible. And the related point here is that, just like an anecdote for me, when I used to work with the NAIC statutory accounting data at the Chicago Fed, at the quarterly level for U.S. insurers, you get CUSIP level data on their balance sheet holdings. It's some of the best, most detailed data I've ever seen. I tell people working in corporate finance, even if they're working on projects that are not related to insurance specifically, to use insurance as an empirical setting because the data is so rich. But if you conduct one of these, so-called shadow reinsurance transactions, suddenly all of that transparency vanishes. And I remember being shocked that, all we can say is like, oh, this is like the percentage of assets or liabilities that are ceded, to this reinsurer. And we just have no visibility whatsoever into what, shadow reinsurers are doing. We kind of have to just take it on faith. And I think that that's not warranted at all, given the incentives at play to, essentially reinsure excessive liabilities without adequate assets. So I think that this is a major concern. We are seeing some reforms in this area, like so-called asset adequacy testing. I think that those are positive steps. I applaud the NAIC for pursuing these. But I think the lack of visibility into the balance sheets of these like shadow captive reinsurers especially is something that I frankly I'm shocked is permitted.
Pranjal, what's your? I see you nodding. So
yeah, I don't know much out on the reinsurance stuff. I think it's one of those things that's been sort of, from a regulatory point of view, always in this zone of where does anyone believe it's like up to snuff? And then, given the sort of recent concerns about private credit, it just adds on to that layer of worries. I think fundamentally it's a problem. It's been like a long-standing issue with insurance regulation.
Yeah, the valuation opacity of private credit, here, is really like pouring gasoline onto this problem of being able to cede a ton of liabilities without adequately, backed assets.
So actually, this is my last question because so do you think the markets have? Is there a contingent in the markets that have sort of like the scope and understanding of this risk? From what you see, I mean, these are pretty. I mean, whether it's funds or banks, these are sophisticated, data-driven investors. They have to understand what's happening and be pushing in a certain direction. So or is it, I guess, Andrew, what's your perspective on that?
I mean, I think for publicly traded insurers, there's, obviously, there are people who are following this. I believe there are a bunch of institutional investors who have short positions on various insurers. I have no idea if the current pricing for any particular publicly traded insurer is the right pricing or not. Like Pranjal, I similarly believe that if you have a highly liquid, publicly traded market, that it's very difficult to beat that market over the long run. And so people who have like the financial incentives to, pursue, what's going on here are making decisions based on that. But I think in terms of the kind of regulatory and policymaker understanding of shadowy in particular, and I think kind of the transformation that has occurred in life insurance in general, I think we're still at the dawn of being able to like adequately reckon with the regulatory changes that need to be made.
I just had one thing to that. I think one more sort of way to think about the problem is that individual actors don't really have the incentive to sort of worry about systematic risk when it doesn't show up on their balance sheet. So an insurer might be making very prudent decisions that private credit loan is higher yielding. I can capture the extra spread and capture more market share and expand. And maybe they aren't adequately thinking about bankruptcy risk 20 years down the line, right? And that would not be like sort of a bad insurer. That would be sort of rational. So it's really up to the regulator to sort of step in and say the opacity concerns warrant reducing exposure or improving valuation practices or something along those lines. And the second point I want to make is just that it's just from my other research, a basic sort of idea is that bigger firms, bigger insurers might actually have more incentive to take more precaution for the simple reason that they have more to lose in some ways, or they're better monitored. I think a lot of the problems in such regimes come from like smaller firms typically called fly-by-night firms, where they have a greater incentive to take risk and do sort of crazier things, because when they go bankrupt, they have less sort of employees to worry about, or the manager is less worried about the empire they have, and the regulator is not on the ball because it's like, oh, it's only a $2 billion insurer. Why would I spend so much time thinking about this asset, this like one transaction? So that's another sort of lesson, is to think a lot about like size and how that interacts with the regime.
Great. You've been so kind with your time and really spot on, really interesting stuff. So I thank you very much for taking the time.
Thanks so much, Chris. This was very fun.
Yeah. Thanks for having us on.